The US dollar has been trading softer on near-term strategies, but the longer-term view points to higher levels or consolidation. We call it Miss USA at Investiva and monitor her dance moves closely on the Forex dance floor. But what are 4 pillars of the US economy that can have major impacts on the US dollar in the long run? My name is Kiana Danial with Investiva, and this is your Forex trading analysis for the week as a bunch of currency pairs dance a week away on the Forex dance floor. For 6.5 years, the Federal Reserve has held its key interest rate near zero, and for nearly that long, the financial world has speculated about when the Fed will start raising it. After its March meeting, the Fed opened the door to a rate increase this year by no longer saying it would be patient in starting to raise its benchmark rate. Most economists had said that dropping patient from a statement would mean the Fed could raise interest rates as soon as June, something that would course through the economy and could slow borrowing and squeeze stocks and bonds. Yet, at a new conference later, Fed head Janet Yellen stressed that while the Fed had removed patient to describe its approach to raising rates, it still hadn't decided when to start raising them. Yellen said any decision would depend mainly on what the latest economic data showed, and the data since then has been disappointing. So, will we see an interest rate hike in the US? Yes. Will it be soon? Stay tuned at least until Wednesday with new Fed statement. The second pillar is the jobs market. The U.S. employment sector took a big hit in March when the net jobs added came in way below the market expectations at 126K versus 245K forecast. However, the number of Americans seeking unemployment benefits was little changed last week, evidence that employers are cutting few jobs. That this could be a sign that the growth and slowdown will be temporary. Some gloomy analysts, however, are expecting a rise in unemployment claims this week, which could have a negative effect on the strength of US dollar in near term. Now, for consumer confidence, our third pillar, it increased in April to the second highest level in more than 8 years, as Americans perceived a more optimistic outlook with the economy and inflation rate. According to the University of Michigan, the preliminary index of sentiment rose from 93 in March to 95.9 this month. Hopes for future jobs and income prospects, lower fuel costs, and finally, end of winter are the main drivers of consumer spending. The final pillar we look at today is the US GDP. This year has so far followed last year's pattern in GDP growth. Another bad winter and another bad start to the year. Following this pattern, most investors view this first quarter slowdown as a temporary setback in what they still expect to be a strong year. First quarter GDP is expected to grow a disappointing 1.3% at most. Economists' estimates for second quarter GDP growth, however, have actually risen recently to more than 3% from 2.8% in January. All in all, the future remains bright for Miss USA, but that doesn't mean that dollar bears can earn small amount of pips shorting the currently ranging US dollar versus other major currencies. Follow my daily signals on Investiva.com and on our social media for latest updates. Sign up for a private webinar with me to get answers about your personal trades, and don't forget that only you can take care of your money the way it needs to be taken care of. So get yourself educated.